In March of 2020, the Federal Reserve printed $4 trillion in 8 weeks. In 2021, Congress sent checks to people who never lost their jobs. In 2022, Russia got locked out of the SWIFT payment system for invading Ukraine. In 2023, China and Brazil started settling oil trades in yuan. In 2024, central banks bought more gold than any year since 1950. And right now, in early 2026, the yield on a 10-year treasury is higher than it was during the peak of the inflation crisis. So here's my question. When does a recession stop being the thing we should worry about? Look, I've been managing my own money for over a decade. I've got multiple hundreds of thousands of dollars spread across index funds, real estate, and yeah, some gold. I'm not here to sell you panic or tell you to buy my course on how to survive the collapse. I'm here because I spent the last 3 months reading the actual documents. SEC filings from Bridgewater Associates, IMF working papers on reserve currency transitions. The Bank for International Settlements reports that nobody reads because they're 800 pages of Yanghan speak. And what I found is this: we're not heading into a recession. We're heading into something structurally different, a change in the rules of money itself. And your 401k was built for a game that's ending. So in the next 15 minutes, I'm going to walk you through the actual mechanics of how monetary systems die, why every signal Ray Dalio talked about in his changing world order framework is flashing red right now, and what this means for anyone trying to retire in the next 20 years. Because here's the thing, the psychology of money isn't about picking stocks. It's about understanding which game you're playing. And right now, most people are still playing checkers while the board is being swapped out for chess. Quick thing, if you want to see what your retirement actually looks like under different scenarios, I built a calculator based on the same institutional formulas Vanguard and BlackRock use. It factors in inflation, taxes, realistic yield, and the psychological trap of inconsistent contributions. Most free online calculators are mathematically wrong because they assume a world that doesn't exist anymore. This one lets you play with the numbers. What if you get 1% more annual return? What if you add $500 a month? I'll ask for your email so I don't store your financial data. Hundreds of people have already used it. Link in the description. Now, let me explain how monetary systems actually work using a metaphor we can keep coming back to. Think of the global financial system like a massive commercial lease. After World War II, the world signed a lease with the United States. The terms were simple. The US dollar would be the global reserve currency. Everyone would trade oil, goods, and debt in dollars. In exchange, the US would maintain a stable currency, keep inflation low, and provide military security to keep trade routes open. That lease has been running for 80 years. But here's the problem with long leases. The landlord starts taking liberties, and the tenants start looking for other apartments. The first liberty the US took was in 1971 when Nixon closed the gold window. That was the moment the dollar stopped being backed by anything except trust. And for a while, trust was enough. The US had the biggest economy, the strongest military, and everyone needed dollars to buy oil. But trust is a psychological asset, and psychological assets decay when you abuse them. Let's talk about abuse. The US national debt is now $36 trillion. That's 120% of GDP. To put that in perspective, if you made $60,000 a year but owed $72,000 on credit cards, your debt-to-income ratio would be the same as the United States government. Now, you might be thinking, okay, but we've had high debt before. True. After World War II, debt to GDP hit 106%. But here's what's different. Back then, the US had a young population, a manufacturing base, and it was a net creditor to the world. Now, the US has an aging population, offshored manufacturing, and borrows money to pay interest on money it already borrowed. That's not a debt problem. That's a Ponzi problem. And here's where the psychology gets interesting. When you're running a Ponzi scheme, you have two options. You can admit it's a Ponzi scheme and restructure, or you can keep it going by finding new buyers. For the last 15 years, the Federal Reserve has been the buyer of last resort. Every time Treasury yields started spiking, meaning nobody wanted to lend money to the US government, the Fed would step in and print money to buy bonds. That's called monetizing the debt. It's also called inflation. But that trick only works if the rest of the world still needs dollars. This is where it gets really interesting. The second sign of a dying monetary system is what Ray Dalio calls the big cycle of internal order and disorder. Basically, when wealth inequality gets extreme, societies fracture. The data on this is wild. In 2024, the top 1% of Americans held 32% of all wealth. The bottom 50% held 2%. That gap is wider than it was in 1929, right before the Great Depression. Now, inequality alone doesn't break a system, but it creates the conditions for political instability. And political instability makes people nervous about holding long-term government debt. If you think a country might have a civil conflict or a government that defaults on obligations, you don't want to lend that country money for 10 years at 3% interest. So what do instead? You buy gold. You buy real assets. You move money into currencies that aren't tied to a politically unstable system. And that's exactly what we're seeing. Central banks around the world bought 1,037 tons of gold in 2024. That's the second highest year on record. China, Russia, India, Turkey, they're not buying gold because they think it's pretty. They're buying it because they're quietly exiting the dollar lease. Now, you might be thinking, but Tom, countries have been predicting the death of the dollar for decades. It never happens. Fair point, but here's what's different this time. The third force in Dalio's framework is external order and disorder, geopolitical conflict. And right now, we're seeing the most significant realignment of global power since the end of the Cold War. Russia invaded Ukraine and got kicked out of the SWIFT system, which is the global messaging network for bank transfers. That was supposed to cripple them. Instead, Russia started settling trade with China in yuan and rubles. China and Brazil cut a deal to trade in their own currencies. India is buying Russian oil with rupees. The Gulf states, who have priced oil in dollars since the 1970s, are now talking openly about pricing in multiple currencies. This isn't theory. This is happening right now. And here's the kicker. When you weaponize the dollar, you teach the world to build a financial system that doesn't need the dollar. That's not a conspiracy. That's incentives. If I can lock you out of the payment system because I don't like your foreign policy, you're going to build an alternative payment system. And once that alternative exists, everyone who's nervous about being next in line starts using it too. It's the same psychology as a bank run. The bank doesn't fail because it's insolvent. It fails because people think it might be insolvent, so they pull their money out, which makes it insolvent. Self-fulfilling prophecy. Now, let's get concrete. Let me show you what this looks like for an actual person. Meet David. He's 42. He's got $350,000 in his 401k, all in a target date fund. He makes $110,000 a year. He's contributing 6% of his salary. His employer matches 3%. According to every retirement calculator he's used, he's on track to retire at 65 with $1.8 million. Sounds great, right? Except that math assumes three things. It assumes 7% average annual returns. It assumes 2.5% inflation. And it assumes the dollar he retires with in 2026 buys roughly the same basket of goods as the dollar he retires with in 2049. Here's the problem. If we're entering a period of monetary transition, all three of those assumptions break. Let's say the US government, facing a debt crisis and unable to find buyers for treasuries, decides to let inflation run hot to erode the real value of its debt. That's not speculation. That's what every country in history has done when it couldn't pay its bills. If inflation averages 5% instead of 2.5% over the next 23 years, David's $1.8 million in retirement only buys what $800,000 buys today. He just lost $1 million of purchasing power, and he doesn't even know it yet. His statement still says $1.8 million, but the game changed underneath him. And it gets worse, because if the dollar loses its reserve currency status, even partially, US interest rates have to go up to attract buyers for government debt. Higher interest rates mean lower stock valuations. The S&P 500 is priced for an environment where the US can borrow cheaply forever. If that assumption breaks, we're not talking about a 10 or 20% correction. We're talking about a repricing of every financial asset in dollar terms. David's target date fund, which automatically shifts to bonds as he gets older, would get destroyed. Bonds lose value when interest rates rise. That's not a prediction. That's math. Now, to be fair, this doesn't happen overnight. Monetary transitions take years, sometimes decades. But here's the thing about slow-moving disasters. People don't adjust their behavior until it's too late. It's the same psychology as climate change or smoking. You know it's bad, but it's not bad today, so you don't change anything. And then one day it's bad, and you can't undo 20 years of compounding mistakes. So what does the US do? It has two options. Option one is to fix the underlying problems. Cut spending, raise taxes, get the debt under control, rebuild trust in institutions. But that requires political will. And political will requires short-term pain for long-term gain. And in a democracy where elected officials are optimizing for the next election cycle, not the next generation, that's not going to happen. So option two is to change the rules of the game. And this is where it gets weird. There's a real possibility that the US moves to a commodity-backed currency, not full gold standard, but something like issuing treasury bonds backed by gold reserves. Judy Shelton, who Trump tried to appoint to the Federal Reserve, has openly called for this. The idea is that if you back the dollar with something tangible again, you restore trust and bring countries back into the dollar system. The US supposedly has 8,000 tons of gold in Fort Knox. At current prices, that's worth about $630 billion, which sounds like a lot until you realize the US national debt is $36 trillion. You'd need to revalue gold at over $4,000 an ounce just to cover 10% of the debt. And if the US doesn't actually have the gold it claims, which has never been audited in any meaningful way, the whole plan falls apart. Or maybe the US pivots to a digital reserve system. Bitcoin is already being hoarded by nation states. El Salvador made it legal tender. The US reportedly holds over 200,000 Bitcoin, seized from criminal enterprises. If the US announced a strategic Bitcoin reserve and started issuing bonds backed by Bitcoin, it would legitimize crypto as a reserve asset overnight. And if you're wondering why the US suddenly moved into Venezuela, a country rumored to hold 600,000 Bitcoin, well, maybe you're starting to see the incentives line up. But here's the problem with all of these solutions. They require coordination. The US can't unilaterally declare a new monetary system and expect the world to follow. After World War II, the US could do that because Europe was in ruins and needed dollars to rebuild. Now, China has the second largest economy in the world. The European Union is a massive trade bloc. India is rising. These players have options, and if they don't like the new rules, they'll just build their own system. Which brings us back to the lease metaphor. When the lease is up, the tenants don't have to renew. They can move out. Now, there's a fourth force in Dalia's framework that we haven't talked about yet. Acts of nature. Pandemics, natural disasters, things you can't predict, but that accelerate everything else. We saw this in 2020. COVID shut down the global economy and forced governments to print trillions of dollars, which sped up the debt crisis by maybe 5 years. The fifth force is technology. And this is where things get interesting, because artificial intelligence might be the only deflationary force strong enough to counter all the inflationary forces we just talked about. If AI can replace 40% of jobs, like the IMF says it will, and drive down the cost of goods and services, maybe that buys the US time. But it also creates massive unemployment, which feeds back into internal disorder. You see how these forces all stack on each other? Here's a quick comedic aside. Imagine you're the Federal Reserve chair in 2028. You're sitting in a room with advisors. One guy says, if we raise rates, we crash the stock market. Another guy says, if we lower rates, inflation goes to 10%. A third guy says, if we do nothing, the bond market revolts. And you're just sitting there thinking, I should have taken that job at McKinsey. Or picture this. You're Xi Jinping, You've spent 20 years building the Belt and Road Initiative, lending money to developing countries, trying to create a yuan-based trade network. And then the US announces it's backing the dollar with gold or Bitcoin or magic beans, whatever. And you have to decide, do you call their bluff? Do you dump your treasury holdings and crash the US bond market? Or do you cooperate, knowing that cooperation means staying in a system where the US still writes the rules? It's like playing poker where the dealer can change the rules mid-hand. At some point, you stop playing. So let's bring this back to the hook. What's coming is worse than a recession because a recession is a cyclical reset within a stable system. Demand drops, companies lay people off, prices fall, the Fed cuts rates, and eventually the economy recovers. We've done this dozens of times. But a monetary transition is a structural reset of the system itself. The rules change. The measuring stick changes. And if you built your entire financial plan assuming the old rules, you're in trouble. Here are 3 things I'm doing about this. First, I'm diversifying out of purely dollar-denominated assets. That doesn't mean I'm selling all my stocks. It means I'm holding some gold, some real assets, and yes, a small position in Bitcoin. Not because I think Bitcoin is the future of money, but because if there's even a 10% chance it becomes part of the global reserve system, the upside is asymmetric. Second, I'm shortening my duration on fixed income. Long-term bonds are a terrible bet right now. If rates go up, you lose. If inflation stays high, you lose. I'd rather hold short-term treasuries or even cash and wait for clarity. Third, I'm investing in skills and businesses that aren't denominated in any currency. The value of what you can do or build doesn't change just because the monetary system does. And look, maybe I'm wrong. Maybe the US figures this out. Maybe China and the US cut a deal at some G20 summit and we get another 50 years of dollar dominance. But the data says otherwise, and I'd rather be early than late. Here's the thing people don't understand about monetary transitions. They think it's this dramatic event. One day you wake up and the dollar is worthless and we're all using gold coins. That's not how it works. It's a slow grind. It's your grocery bill going up 5% a year instead of 2%. It's your bond fund underperforming. It's the slow realization that the retirement you planned for isn't the retirement you're going to get. And by the time you realize it, you've lost a decade of compounding you can't get back. Ray Dalio has been screaming about this for 5 years. Bridgewater Associates, his hedge fund, manages over $100 billion. These guys don't make bets based on vibes. They model this stuff using data from the last 500 years of empire cycles. And every model they run says the US is past its peak and entering the decline phase. That doesn't mean collapse. It means transition. And transitions are messy. So yeah, we might get a recession in the next 2 years, but the recession is just the symptom. The disease is a monetary system that's been running on fumes since 2008, held together by central bank printing and the collective agreement not to acknowledge that the emperor has no clothes. And at some point, somebody acknowledges it. Maybe it's a bondholder who refuses to buy treasuries at 3% when inflation is 5%. Maybe it's a foreign government that decides to settle oil trades in yuan. Maybe it's just the slow accumulation of 1,000 small decisions by people who stop trusting the system. But once it starts, it's hard to stop. And the cruel irony is that the people who get hurt the worst are the ones who did everything right. Saved money, maxed out their 401k, bought index funds, believed the system would reward patience and discipline. And it did, for 80 years. But the system is changing. And if you don't change with it, you're going to wake up at 65 with a number on a screen that doesn't buy what you thought it would buy. I've spent over 10 years running my own business, working with accountants and fiscal lawyers who showed me how money actually moves behind the scenes. And here's what I've learned. The game isn't about being smart. It's about understanding which game you're playing and when the rules change. Most people are still playing the game from 1985. Low inflation, stable dollar, bonds as a safe haven, stocks go up over time. That game is over. The new game has different rules, and we're all figuring them out in real time. Lazy investing built more fortune than crypto memes. But lazy investing in this environment means understanding macro forces, not ignoring them. It means asking uncomfortable questions about what your portfolio is actually worth if the measuring stick changes. And it means being intellectually honest enough to admit that the world your financial plan was built for might not be the world you retire into. The lease is up. The tenants are moving out. And if you're still sitting in the apartment, assuming everything will be fine, you're going to be the last one left holding the bag when the landlord turns off the utilities.